Good afternoon, ladies and gentlemen, and a warm welcome to our webinar titled Finnovate, the Evolving Fintech Landscape. Whilst most of us are aware of Acuité Ratings and Research Limited, I'd like to touch upon a short brief on Acuité. Acuité Ratings and Research Limited is a full service rating agency registered with SEBI and accredited by RBI. Acuité is an institutionally promoted and owned rating agency. The promoters are Sidby and Dun& Bradstreet. The other shareholders comprise 9 banks, including SBI, Bank of Baroda, Bank of India, Punjab National Bank, Union Bank, Canara Bank, ICICI Bank, Indian Bank, and Stanseed. Acuité has assigned ratings to various loans and debt programs of over 9,200 entities. It is the flagship company of Acuité Group and has two wholly owned subsidiaries. One subsidiary is ESG Risk Assessments and Insights Limited, India's first ESG rating company that has coverage on top 1,000 listed entities. The second subsidiary is Smedha Ratings Private Limited, world's first SME-focused rating agency. Smedha has completed over 50,000 MSME ratings across 300 industry clusters in 400 districts. Besides SME ratings, Smedha also offers credit due diligence, MFI gradings, and code of conduct assessment for MFIs. This is the first webinar from our new Acuité NBFC Insights Series 2022, where we will bring in distinguished speakers from different segments of NBFC to discuss the evolving nature, the opportunities, and challenges in the respective asset classes. Before we start, I want to bring the attention of all our attendees to the Q&A box appearing in your Zoom controls panel. Please do send us all your queries in this Q&A box, and we will try to answer as many as possible towards the end of this webinar. Let me share a brief agenda for today's webinar. To start with, we have a keynote address from RBI, followed by a presentation by Acuité team, and then a panel discussion with 4 eminent persons from the financial sector, which will be moderated by a Chief Analytical Officer. Post the discussion, we will be taking audience questions in the Q&A session prior to the closure of the webinar. Let me also introduce the subject of today's webinar in brief. Fintech, as we all know, is an emerging segment in the financial sector driven by technological innovations. Lending through fintech platforms has seen a visible pickup over the last few years. Despite the COVID disruption, the assets under management for fintech lending segment has recorded a whopping 48% CAGR between March 19 to FY22. Initially regarded as a threat to banks and traditional NBFCs, fintech lenders have become their partners, complementing the banks and NBFCs with their cutting-edge technologies and innovative business models to enhance mutual growth. We now move on to an insightful presentation on the lending fintech sector by our team. To present this, I will be joined by my colleagues Mohit Jain and Sumit Pramanik. Mohit Jain is a Senior Vice President and Head of Financial Sector Ratings in Acuité. He has over 17 years of experience in credit ratings, debt capital markets, and product development. Sumit Pramanik is Senior Manager, Financial Sector Ratings, and leads Securitization Ratings in Acuité. He has over 8 years of experience in business analytics and credit ratings. He is an electronics engineer with an MBA from IIM in Indore. Over to you, Mohit.
Thank you, Vinny. Good evening, everyone, and welcome to the Acuité webinar on the Fintech NBFCs. Over the years, there's been a lot of buzz about the Fintech world. On the one side, we can see a continuous flow of the investments in this sector, but the other side, we see a growing concern on the profitability of this sector. And of late, the regulators are expected to come with the regulations on the fintech industry. So Acuité have identified 25 companies in the lending fintech space, predominantly from the personal loan space and SMB space, to share the insights on the lending fintech and understand the evolving landscape for the same. As per the presentation flow, I will take upon the first 3 topics, which are namely investors' interest in the Indian fintech industry, key trends in the fintech, and the performance of the asset classes like personal and SMB fintech. Then I would ask my colleague Sumit to take upon the remaining three slides, which are Acuité Fintech Universe, regulations and compliance, trading criteria for lending fintechs. Globally, calendar year 2021 has been quite remarkable for the fintech industry, where the record number of deals, 5,686 were recorded, and the investment flow was $210 billion. Now let's see how the investment trend is shaping up in India. As we can see from the chart, the breadth of fintech solution attracting the investors continue to grow year on year. Particularly 2021 has been a phenomenal year for the Indian fintech industry, where we can see the number of deals touched was 280 and the funding amount was $7.9 billion. And if we see the performance till date, which means till June, the deals clock is 160 and the amount received is $3.5 billion. So the momentum is continued. So few things which is worth mentioning here is about the vibrant investment ecosystem in India. Besides P and VC firms, there are sector-focused incubators, accelerators, and tech hubs which are benefiting the fintech industry with their investments. Okay. Other observation which can be made that out of these huge investment, the investment is concentrated largely amongst these top three investors. To put the data perspective, around 50% of the total funding is largely coming from the top 30 investors. But having said this, in the subsequent series of investment, we see a lot of participation from the same set of the investors. The fintech spectrum is quite widespread. The major segments includes the lending fintech, and which is the point of discussion in today's seminar. And the lending fintech have players in digital lending space, new banks, and digital lending space is well diversified across various asset classes, including SME, personal loan, gold, auto, and also entering into education field. Then we have wealth tech or investment tech companies, which are largely operating as a discount brokers, investment platform. The well-known names there are Zerodha, Grow, and Upstock. Insurance tech has also emerged as one of the key areas in the fintech, where the digital insurers like Acco and Digit are quite prominent, and Policy Bazaar remains one of the key insurance advisors. Payment remains one of the largest portion of this entire fintech industry, with a lot of unicorns to name like Paytm, MobiKwik, Cred, etc. Of late, the fintech has also evolved, and Khata Book is a prominent name under this category. We see a huge market opportunity in the fintech space. It is estimated that as of now, the market potential is around $584 billion across the entire fintech industry. For the lending fintech, the potential as of now is $270 billion. And just in a span of 3 years, from 2000 to 2025, we see this market potential doubling, more than double, to around $611 billion. The drivers for this remains untapped SMB space and also the evolving personal loan space. As per the study from reputed international agencies, the total credit demand for SMB space is around $600 billion, and of which 50% comes from the informal sources. So if we consider this and to add to the other asset classes evolving in the lending fintech, we can well see the market potential is quite huge. Now we will share our insights on the lending fintech industry. We will start with assets under management. Since personal loan and small business loans predominantly cover the major portion of the AUM, our study analysis is concentrated largely on these two asset classes. Now, if we talk about the AUM composition, the SMB loan takes a major share, around 72%, and this trend has been there from last 3 to 4 years. Now, talking about the AUM, we can see there has been steady growth in the AUM, notwithstanding the COVID pandemic. And we can see that the fintech, the lending arm has done slightly better than the NBFCs during the COVID period. Talking about the disbursement trend, unlike AUM, there's some unevenness in the disbursement. There was a decline of around 50% in the disbursement in 2021. Reason is because of the disruptions because of pandemic. But the good part is that the recovery has been quite fast, and as per the estimates, the disbursement volume is estimated around 24,900 crores, well surpassing the pre-pandemic levels. Now, while we talk about the disbursement trends, we also evaluated one of the key attributes of the disbursement, which is the average ticket size. And this is particularly for the personal loan division. So the average ticket size is seen around 6,886 for year 2022, and it has been hovering around 6,000 range from last 3 years. And this is much below the average ticket size for the MFI industry. So the point which I want to make here is because of a lot of technological innovations and cutting edge technology, this sector is really revolutionizing how the small size unsecured personal loans are given. And just because of these factors, loan as small as 800 rupees or 1,000 is also given very quickly through the digital lending. And this is also adding to a lot of disbursement volumes, which we see year on year. There's been always a concern on the earning profile of the lending fintech space. Let me share our perspective on this. First, we will start about the earning profile of the personal loan space. So if we can see the pie chart for FY 2021, the percentage of company making losses was 73%. There can be a significant improvement in the earning profile at the industry level for the personal loan space, where now 62% companies are making profit. Similarly, if we see the PAT and ROTA trend, this space has largely been into profit barring FY 2021. So this the challenges on profitability are slightly less. Now, when we compare with the earning profile of the small business sector, the views are slightly different, where we see in 2021, 73% of the companies were making losses. Now in 2022, it is slightly widened and around 82% of companies are making losses. And if we see below the PAT and the ROTA trend, Collectively, this space has been into losses. Of late, year on year, the losses have widened. So the reasons which can be attributed for better profitability in the personal loan is largely because of the different uh, business model for the personal loan. The model is different because of two reasons. First, of very low ticket size, which, and second is the average tenure is too small, roughly from 2 to 4 months, because of which the ROI again is because of the interest rate charged and the processing fees. The annualized ROI for this space lands to 45 to 60, which adds to the profitability of this sector. Uh, and fintech small business have the tenure between 2 to 4, and the ROI is not as high as compared to personal. That's why the profitability trends are slightly divergent. Now, if we see the asset quality, uh, if we see for the personal loan, the median GNPA, we see a slight moderation in the GNPA in 2022. But one important observation here is the difference between the minimum companies operating at minimum GNPA and the company operating at maximum GNPA within the fintech personal loan segment is widening year on year, and this gap for 2022 has further widened from 1.3 to 11.16. So this signifies a huge difference between their delinquency levels. Now, if we come to the trend for small business, the GNP levels are surging year on year, and like the personal loan space, there is also a huge difference between the companies operating at a minimum GNPAs and the company operating at a maximum GNPA. So this wide difference between minimum and a maximum GNPA very clearly reflects the importance of very sound risk management practices and very efficient collection mechanism. Because if these things are not there, the GNPA levels can rise very sharply. Now, again, coming to slight better performance of the personal loan space with regard to small business and asset quality uh, can be attributed for two reasons. First, within for the personal loan space, uh, the policies for write-off are quite aggressive. So as the write-offs are done frequently, it helps in moderating the GNPA levels. And the other factor is that the high GNPA levels and the relatively high GNPA levels in the small business segment is also because the operating environment for the SME space still remains quite challenging, which is reflected in the asset quality. Now, if we talk about the leverage, uh, the leverage is quite comfortable for the personal loan space, which stands at 1.3 for FY 2022, and this has been hovering around same levels from last 2-3 years. The gearing levels are slightly high for the SMB business segment, and we have seen a rise from 1.9 to roughly 3 times. Now, one thing which can be noticed for the personal loan space, that given lower leverage, the growth observed is largely because of the equity capital infusion, and the participation of the lender is slightly limited. However, going forward, for the scalability and the sustainability of that, it is very important that there is active participation of the lenders in this space. Now, I would like to call upon my colleague Sumit to take up the presentation from here. Thank you so much.
Okay. Thanks a lot, Mohit. Hello and good evening to all the participants. So now let us have a look at the industry level rating distribution for fintech companies. Okay. So we can see that in spite of some challenges in the earning profile, the ratings of around 87% of the fintech companies remain in the investment grade. This is mainly because of the regular capital infusion in the fintech companies. Now, having said that, the rating distribution is concentrated in the lower range of the investment grade, which is the triple B category. Over the years, we have seen minimal downward transition in the rating scale for fintech companies. On the other hand, there has been a few fintechs that have been either upgraded or given a positive outlook. So that was the rating distribution table. Now moving on to a bit deeper level into Acuité's rated fintech universe. So we can see a wide diversity in the asset classes. If we go through the company names, we can easily see that these companies belong to different asset classes. There's a wide diversity that can be observed. Acuité has rated personal loans and SME loans providers. Acuité has also rated fintechs in the gold loans and vehicle loans space, which is quite interesting. And some of Acuité's notable clients include CrazyBee, SlicePay, Rupeek, among others. Acuité has also rated securitization transactions for most of these clients. Such transactions include pass-through certificates and partially credit-enhanced term loans and NCDs with a third-party guarantor. So there has been quite a few securitization transactions also that Acuité have rated in this space. Next, moving on to the impact of regulations and compliance in the fintech ecosystem. Now, the proposed regulatory guidelines talk about three main things: technology neutrality, principal-backed regulation, and addressing regulatory arbitrage. So, as per the working group of RBI, they have recommended a three-pronged measure. Some of the key recommendations are as follows. Number one is the legal and regulatory recommendations. So as per them, a nodal agency should be set up, which will primarily verify the technological credentials of the digital lending applications. In terms of recommendations related to technology, they have said that compliance with prescribed baseline technology standards should be a precondition to offer digital lending by the regulated entities. Last but not the least, in terms of recommendations related to financial consumer protection, the working group has mentioned that each lender should provide a key fact statement in a standardized format. So we just touched upon some of the key recommendations proposed. This is not the full list, of course, but these are the key ones.
Thank you, Mohit and Sumit. That was a rich and enlightening presentation.
So next,
apologies.
So some more question is remaining. So next we'll move on to the rating criteria for lending fintechs. So first and foremost, we'll look at the quality of the business model. Okay. So this is Acuité's view towards how to rate fintechs. Now for fintechs, there are two arms. One is the tech arm and the other one is the NBFC arm. So generally the tech arm is more capital intensive. Therefore, it is very critical to evaluate both the arms of the fintech company taken together. And precisely for this reason, Acuité takes a consolidated approach for rating such companies. Now, why is it critical to assess the quality of a fintech's business model? Right. So it is very important to assess the business model in terms of asset class, the tenure of the loan, and the average ticket size. Now, for example, for personal loans, the loan tenure is around 2 to 4 months with an average ticket size ranging from say 10,000 to 12,000 rupees. Now, in contrast, for SME business loans, the loan tenure can go as high as 2 to 5 years with a much larger average ticket size. Therefore, it is important to evaluate each fintech's business model individually. Now, there has been some level of concern on the earning profile of fintechs. Mohit also mentioned this before. This is a result of high IT expenses and credit costs. Therefore, Acuité takes into account the break-even period for the fintech companies as well. In addition, we also consider the type of FLDG, that is first loss default guarantee arrangements in the co-lending tie-ups of the companies. Particularly for personal loans, because of the short tenures, it becomes important to also look at the collection efficiency trends and the collection mechanism in place. So that's that on the business model side. Next, diving deeper into the evaluation of the financial position. So as mentioned before, a regular infusion of capital is a healthy sign for the growth of fintechs. Therefore, Acuité looks into the past as well as future planned capital infusion for the company. Since personal fintechs are fast amortizing, the AUM doesn't always give the correct picture of the company's growth. Now here, there's a slight diversion from the analysis of traditional NBFCs. So instead of an AUM growth, Acuité emphasizes on analyzing the trend of total disbursements for fintechs especially. Since many of the fintech companies are still at a loss-making stage, as Mohit has already said before, an evaluation of the pre-provisional profit gives a better indication of the company's health than just a simple plain profitability trend. Another important parameter that we look at is the ROI. So the annualized ROI for personal loans can go as high as 45 to 60%, while for SME loans, the annualized ROI falls somewhere in the range of 25% to 35%. So there's a huge difference in that also. Therefore, Acuité looks into the ROI section as well. In addition, Acuité also evaluates the write-off and provisioning policies of the fintech companies along with the trends. Now moving on to some other factors that we consider while rating lending fintechs. So we have already mentioned the importance of capital infusion and the background of the investors and how much their confidence plays a role into making the growth story of fintech possible. Therefore, the profile of the investor and also the profile of the leadership of the company must be analyzed thoroughly. Now, as we all know, the fintechs are technology driven in their underwriting, credit risk evaluation, disbursement, and collection processes. So therefore, we also take a very close look at the technological backbone and the policies of these companies. Thus, Acuité believes that the capability of fintechs to handle the risks from regulatory and compliance changes will also play a vital role going forward. Finally, to round up, I would like to summarize a few key observations from the presentation. So due to the expectation of the new guidelines from RBI on first loss default guarantee arrangements, Acuité believes that there might be some short-term uncertainty in the fintech ecosystem. However, over a longer period of time, Acuité believes that the regulations will bring in more sustainability and organize the industry, which currently is slightly unorganized. And looking at the trend of equity infusion, although there are some issues in the earning profile of fintechs, the companies have been successful in garnering investors' confidence and getting capital infusion, which is a really good sign for the segment. We also had a look at the different gearing levels for different asset classes, and we saw that the gearing levels for SME lending players have increased from 1.6 to 3 times over the past 3 years. So against this, the gearing for the personal loans fintech players have remained comparatively low at around 1.3 times. Also, as mentioned before, the profitability in this sector is still a bit stressed, and its development in the future will remain a key monitorable. So thus, to conclude, no doubt fintech is an exciting space. However, going forward, for the sustained growth of this sector, the participation from the lenders is very critical. It is expected that with the increase of seasoning and as the track record becomes longer, the participation of lenders will increase. However, this sector will be subjected to the quality, earning profile, and adherence to regulations, these kind of risks. So that's all from the presentation. Thanks a lot for your attention and patience. Now I will hand it over to Vineet. Vineet, please. Thank you.
Thank you, Mohit and Sumit. That was a rich and enlightening presentation, especially imparting on us how much of a stride the fintech sector has made and what all opportunities it holds. Let us now head into panel discussion. Today's panel includes a diverse mix of participants. From the fintech players, we have Mr. Alok Mittal, the co-founder and CEO of Indify, India's leading full-stack platform for enabling debt financing for small businesses. Mr. Mittal is also an active angel investor, a co-founder of Indian Angel Network, and on the board of TAI, the Indus Entrepreneurs Delhi. Prior to Indefeed, he set up and ran Canon Partners Venture investment business. Earlier, Alok co-founded jobsahead.com, a leading web-based recruitment business in India. He is a computer science graduate from IIT Delhi and masters from University of California, Berkeley. Our next panelist, again from the fintech lending space, is Mr. Vivek Veda, the co-founder and CFO of CreditBee, India's leading digital platform. Mr. Vivek also serves as director at Crazy Bee Services Private Limited and has co-founded Fintech Association for Consumer Empowerment, a non-profit organization with the intent to work with all stakeholders to proactively evolve consumer-centric practices in the Indian fintech digital lending space. With over 14 years of experience in finance, Mr. Veda is a chartered accountant and has done his BCom from Delhi University. To provide a banker perspective on the fintech sector, we have Mr. Rakesh Bhojnagarwala, Senior Vice President at Axis Bank, where he heads new economic coverage. He has over 20 years of rich experience in financial services with MNC banks, dealing with large corporates, debt syndication, mergers and acquisition, equity capital markets, and transaction banking. Mr. Rakesh is a qualified chartered accountant and company secretary in addition to MBA in finance. We also have Mr. Pranay Jain, Director, Aventis Capital. He heads digital and technology segments at Aventis Capital, India's premier investment banking franchise. Mr. Pranay spearheads Aventis' fintech coverage, closely working with the founders of some of India's leading fintech firms. He has done his post-graduation from IIM Bangalore and holds an MBA from EBS University, Germany, apart from his BE honors from BITS Pilani. Our Chief Analytical Officer, Mr. Suman Chaudhary, will moderate this panel. With an aggregate experience of over 26 years in credit ratings, research and risk, he has worked in leadership roles in credit rating agencies and the private sector bank in India. Suman is an MBA from IIM Calcutta and a graduate in mechanical engineering from IIT Kharagpur. Over to you, Suman.
Thank you, Vineet. Good evening to you all. We were expecting Sri Pati from RBI, and he is expected shortly for the keynote address. In the meantime, we thought we will continue with the panel discussion. It is indeed a privilege and a real pleasure for me to moderate such a panel discussion, which is going to delve into some of the emerging fintech lending businesses in India. As my colleague Vineet mentioned earlier, we really have an excellent lineup of panelists. He just read out the profile of all of them, who not only represent the industry, but also some other stakeholders like banks and investment bankers. I welcome all of them, and my sincere thanks to them for sparing time for this event. While initiating our NBFC webinar series, when we decided to do this, we thought we will start with fintech lending first, because it has been one of the fastest. What we saw is it's one of the fastest growing segments in the NBFC space post the pandemic. It's also a segment where we know that there is a significant regulatory focus. So the way we will proceed in this panel discussion is in a sequence, and I will come to each of the panelists, starting with Alok, and we will discuss some pointer, and that is how we will do 3 rounds. So the first panelist for this discussion will be Mr. Mittal. So Alok, I think Mohit also touched upon this, that there is a study by a leading global strategy consultant about the opportunity in the whole fintech space and also in the lending tech market, which is huge. We are talking about more than 600 billion market opportunity by 2025. In this perspective, how do you see the business outlook for fintech lenders over the next few years?
Thank you, Suman, and thanks for having me over. So Suman, you're right. There is a massive market opportunity for digital lending over the next few years. I think this market opportunity is a direct consequence of the exclusion that small businesses have faced in the credit space. All of us are aware that only about 15% of small businesses get access to formal financing through the conventional system. I think to me, the more interesting part of this question is, what are the capabilities that digital lending will bring to the fore that will allow us to address some of this market gap, right? Because the incumbents, banks and NBFCs, are equally hungry, are well capitalized, have great people. So I think that is the core of the issue. And the 2 or 3 levers that I am seeing, getting realized. One is to significantly lower the operating cost of doing business, right? We have now seen evidence that digital lending can lower the direct operating cost of SME lending by at least 50%. And that means that the smaller size customers can be addressable profitably, which was not possible in the brick and mortar infrastructure. The second key element is that the standard of underwriting is improving. We have done some experiments internally at NDFC with some of our partners, banking partners. And the accuracy of broad spectrum underwriting that data models offer is, an order of magnitude better than what we as human beings can do. Human beings are not great at calibrating broad spectrum risk. Now, both of these mean that lending businesses can be profitable at a much lower ticket size for a marginal risk customer than what the incumbent businesses can be. And that is going to lead to much higher penetration of credit through digital lending, whether it comes from fintech lenders or it comes from incumbents, that's a capability development question. I think the interesting part here, though, in my mind, is that traditionally new NBFCs have had to climb, a long way before they can start to offer the right cost of capital to their borrowers, right? And we should speak about the role of credit agencies, in that equation. However, the fintech lending universe is evolving in a partnership mode, where banks are coming to these fintech platforms, lending through them, whereby the benefit of lower cost of capital can become accessible to end borrowers much faster than what has been possible in the past. So it's not just a lower operating cost, better credit underwriting, but also more efficient capital structures that are beginning to flow to small businesses. And I think those are the core factors that will help bridge some of the inclusion gap in this space.
Great. Thank you. So I'll come back to you later. So next, let me go over to Vivek. Vivek, consumer loans through fintech has caught up globally and not just in India because of the kind of convenience that the platforms bring. And obviously, we are already seeing a heightened presence here. Will fintech NBFCs have a competitive advantage over banks and other, conventional NBFCs in this asset class, consumer loans asset class going forward?
Hey, thanks, Suman, and good evening, everyone. See, Suman, I don't think so that any of the players, either banks or fintechs, will have any advantage. It's more or less both have their own strength to play with. However, we believe that over a period of time, they will converge and will work on a partnership model to serve the customer in a better way, which even Alok mentioned.
Correct.
See, if you look at Indian landscape, it's a very large landscape where there is a still untapped, unserved market, in spite of such large banks and large NBFCs being present. Over a period of time, the internet penetration, mobile penetration has increased, which is helping the digital lenders or fintech lending companies. Overall, the government is also supporting the digitalization framework in the country, which is giving boost and setting up a very good platform for the fintech companies to grow over a period of time. Where the major difference comes between the banks and the fintech entities is, to start with, if you look at on the basis of brick and mortar model, the banks are incurring a good amount of cost of acquiring customer or cost of underwriting a customer. What does that mean is they have to give a particular ticket size loan to make sure that the cost is recovered. Whereas if you look at the fintechs, since they are acquiring customer digitally, they are underwriting customer digitally or servicing customer digitally, they are in a better position to give a smaller ticket loan to the end customer, right? Second, the turnaround time. For a bank, the turnaround time is much higher, whereas for the digital lenders, it can be on a click of a button. So the convenience plays a major role. Now, banks are still more prone to give loans to the salaried customer, whereas fintechs can, based on their risk model, start giving loans to self-employed because they can start with a lower ticket size. So what we believe is that each player have their own strength to play with. Now, if you look at banks, definitely they have a large balance sheet and a very low cost of funding, which fintechs are still struggling with.
True.
So what we believe that over a period of time, somewhere these two entities or two bodies will collaborate together, where banks will be providing their balance sheet or their regulatory oversight, and the fintechs will act as a customer interfering to onboard the customer and serve them in a better way. So that's the overall belief what we have.
Great, absolutely. So as you said, that it is not that any particular entity has any competitive advantage, but it is about their own strengths that they bring to the table. In this regard, I think Rakesh can give his views on behalf of a private sector bank. He is with Axis Bank. So Rakesh, how do the large private sector banks look at fintech NBFCs as competitors in lending or as potential partners for financial inclusion?
Great. First and foremost, thanks so much for having me here. Extremely delighted to be around. And I agree with my co-panelists, Alok and Vivek. They made a very pertinent point so far that, the space of Indian lending is growing in a big manner. Let's look at the space in terms of how the current incumbents, which are NBFCs and banks, traditionally have been functioning. And you will see that, there's a growing impetus in at least the top private lenders, banks like ours, and worthy competitors like HDFC, ICICI. If you look at our balance sheet recently announced, we are increasingly going for a digital lending with the perspective of bringing down the cost. I guess the point was very well made by my co-panelist Vivek that, there is a huge scope and, there's a operating jaws available to bring down the banking cost of lending. And there's a huge market available for unserved and underserved community which banks wants to reach out. So you need to also understand the change narrative as far as banking, private sector banks are concerned. Earlier, the financial inclusion was seen more from, more to the adherence of the compliance requirement from the RBI side to push for the financial inclusion. But the narrative is now changing. We are seeing a huge profitability scope in going after this unserved, underserved community. We think that, if a bank has the right access to them, then the ability to generate a larger lending book and a profitable business is huge. The scope is pretty amazing, and that is what your presentation also talked about. The fact that the lending opportunity is close to $650 billion and growing further from 2025 and onwards. So here, our approach as a private lender is that we clearly see fintech partners as a collaborator, as a partnership approach. We don't see them as a competitors at all. Today, as we talk, Axis Bank in particular, we have stitched together close to a double-digit tie-ups with the fintech partners, wherein in various forms and shape, we are using this partnership to onboarding our customers, using their platform and reach in a digital onboarding for savings account, current account. We're working with a whole lot of fintech partners in that space. Likewise, even on the lending space, because today focus is more on the lending side, Correct. I will focus more on that. And even on the lending side, we have active, onboarding mandate with at least 4 or 5 prominent fintech players, wherein we are trying to do a collaboration. The scope of the role between the two people are completely divided. We bring the balance sheet on the table. We bring the ability to underwrite large numbers, and the onboarding of the customer, collection of the documents. In fact, that is the onboarding part, and even on the as when the repayments happen, the repayments journey is also done by the fintech partners, and that is where the technology which they bring on the table, the reach and access to the customers, and the risk model which they're able to sort of populate is where we try to sync up together to begin with. And once that sync up happens, then the entire they become a extended hand on the ground to A, onboard the customer, and B, ensuring that repayment is happening on a timely manner. With this partnership, we are able to add to our reach. This is what Axis is doing very proactively. Rather than doing a direct on balance sheet lending to the fintech partners, we're looking at reaching out to the end customer, unserved and underserved community in a significant manner. And this collaboration that way is going to be fruitful for both the fintech partner and the private sector bank like us.
Great. So as Rakesh, you clearly said, the focus is on gaining synergies through partnerships and collaborations between banks and fintech NBFCs. Next, we have Pranay from Avendus Capital. Avendus Capital has been fairly active in the fintech space, done for several transactions. So Pranay, our research shows that the whole fintech space, Mohit showed in his presentation, has received around $8 billion funding in 2021. So do you believe that this capital flows that we have seen in the sector that will continue and that pace, given particularly that, we all know that we are seeing headwinds in the global environment, interest rates rising, there is this quantitative tightening that's happening in the developed economies. So what's your sense on the funding flows?
First of all, Suman, thank you for having me here, and thank you for having me a part of this great panel. To your question, Suman, I think while yes, there is a general slowdown, if you will, in overall funding environment, I think that's a lot more focused towards the technology businesses, and I think that holds true globally as well as here in India. I think calendar year 2021 and first part of 22 was a period of excessive liquidity available in the market and going towards technology businesses. Having said that, I think financial services in general and fintech kind of as a subsector within that does continue to attract interest. I think in the just last few weeks itself, both on the public side as well as the private side, we've seen it. Yes Bank attracting the kind of capital from private investors that it did. Right, Avendus worked on a fairly large home finance transaction, where we advised IIFL from a sovereign wealth fund. I think financial services will continue to attract capital. Specifically on fintech, I think, and as my co-panelists, all of them, Alok, Vivek, and Rakesh all pointed out, right? I think fintech has shown the way and the promise to deliver financial products. First, manufacture the right financial products and then deliver them to the wider masses beyond the metro and the tier 1 cities in a significantly cost-efficient manner. What a lot of fintech businesses have also done over the course of last couple of years is they've demonstrated that their business models are very robust, whether it's the shocks of multiple waves of COVID, and then they've actually broken out in terms of whether you look at from a scale perspective or profitability perspective, right? Which also kind of continues to bolster faith in the sector that that fintechs are kind of here to stay, right? Lastly, I think there would be a few top of the funnel business models, if you will, the business models in fintech which are focused on attracting consumers and still not figured out monetization. I think those might have a relatively tough time, attracting equity capital in this period. But having said that, there is ample dry powder sitting out there, focused towards India, specifically focused towards India tech and fintech businesses. So I don't see capital drying out. We might see, average deal sizes to go down a bit. I think volumes will sustain. The values might come off a bit because again, investors are also looking at a few relatively early stage situations and or taking relatively smaller bets vis-a-vis what they might have been taking.
Great. So funding is not really drying up. There is still adequate funding for the right business models and for the right talent. I think yes, that's a good point. I will come back to Alok. Alok, how do you see you talked about the small business loan, the opportunity there. How do you see the evolving environment for digital small business loans? Globally, is this a very large business? And in India, do you see any challenges in the scalability of this business? We all know that there is a untapped segment, but how scalable is this business? And you can also touch upon the regulatory issues, if any, that needs to be sorted out.
Sure. So, I think small business lending is a problem that exists globally. I can't think of a country that does small business lending well, because some of the constraints to development of small business lending, that we discussed around operating cost, around availability of data for underwriting.
Right.
And I think at some level, the heterogeneity of small businesses, those are common challenges across the globe. There have been examples of successful businesses that have gotten created on back of digital lending in larger geographies. And I don't see why India can't be a leader at this. We must remember that from a digital infrastructure standpoint, India is probably the global leader at this point in time. Digital identity, payment systems. So a lot of the enablers for digital lending are coming into play for the first time in the Indian market. From a challenges standpoint, scalability seems to be available. Right, and I think again the 2 or 3 drivers of this, from a demand standpoint, the scalability is getting driven through digitization. Right, many of these small businesses are becoming accessible digitally. Based on the mobile penetration that exists, based on the online processes that RBI has enabled, whether it is KYC or bank debit mandates and the likes.
True.
Or it is the linkages with ecosystems that is happening more and more. We are leaders in the small business ecosystem lending play.
Correct.
And we are seeing now almost 20 to 25 million of the small businesses being accessible digitally through these ecosystems. And that number is growing at a fast CAGR. So I think the demand side distribution challenges are showing a runway.
Right.
On the supply side, as I mentioned, availability of debt capital has not been a constraint so far, both because of the government support to small business lending and the inclusion being a national priority and not just a private business.
That's true.
But at the same time, also because of some of the co-lending models that have come into play, whereby bank capital is getting available directly through digital lending rather than having to flow through multiple balance sheets to find its way to the borrowers. So both on the demand and the supply side, we are finding this impetus that convinces us that digital lending will find scale. We are seeing that on a micro basis. We are seeing that in the growth rates that us and our peers are experiencing, especially in the post-COVID environment. I think regulation has been a tricky topic globally. We've seen instability in these businesses. We've seen compromise of consumer rights in these businesses, and to that extent, I think RBI has been a good proactive regulator. Even last year, as all of us are aware, there is a report that the working group on digital lending has submitted. We are expecting that final guidelines will come through within the space of this quarter.
Right.
But
it's expected shortly, is what I understand.
Yeah.
Right.
But the 3 organizing principles, the broad principles that we see the regulator being concerned about, are fairly clear at this point in time, right? One is around, transparency of information to the consumers, regarding who the lender is, what is the product being offered, what is the grievance cell number, right? Things of that nature.
Correct.
Second is around integrity of the processes, again in consumer interest, collection practices, KYC practices, things of that nature. And third is around systemic stability, which may flow down from risk-sharing arrangements in these co-lending models. Right? So I think the mature players in the industry are already beginning to comply with the intent of such expected guidelines. And as the mechanisms become more clear, we will comply by the mechanism. But I think proactive regulation in India actually provides us with a lot of comfort that the kind of collapse that we have seen in certain other geographies
Right.
will be less lesser a possibility because regulations are being put thoughtfully and proactively.
Right. Great. I think a very good point that proactive regulation is definitely better for systemic stability and for the health of the sector. And I wanted to also seek Vivek's view on this. The same, how do you see this regulatory, do you see this regulatory issues as headwinds for the industry, or do you think the industry is today prepared to handle if any such headwinds are there?
See, I believe regulations are important for any of the industry to function in a proper manner and for the benefit of all the stakeholders. See, we have seen that over a period of time, as the fintech industry has evolved, regulators are also catching up to make sure that the interest of the customers are protected and there is a level playing field.
Correct.
In spite of that, what we have seen, see, if you look at the lending industry in India, it's always been regulated, right? Now, in spite of that, in FY 2020 December, somewhere there had been a fintech crisis where a lot of unregulated players mushroomed up, or a lot of fintech players did partnership with the NBFC, where NBFC just lent their license without knowing to which customer the fintech partners are lending, or what kind of collection mechanism they are adopting.
Correct.
And then what we realized that over a period of time, not even the RBI, but many other regulatory bodies came into picture when the customers at mass were getting impacted. And then we started seeing that, there were no fair practice code was followed by the NBFCs who are working with fintechs, because they were just lending their licenses. There were a very high interest rate were charged, undue collection practices were followed. And then suddenly there were a lot of rules, regulations came in where RBI came out with a clear circular, what will be the role of fintech entity, what will be the role of NBFC in the overall lending process. There have been a lot of tightenings in terms of the regulators understanding the business model and how the NBFCs are operating. Now what we are seeing is that definitely, what MFI industry has seen when it when it grows up to a certain size, that there was a SRO created, and now we are seeing a similar thing coming into the digital lending framework. So over what we have seen is, as and when the industry will grow, to protect the interest of all the stakeholders, there will be regulations which will come in. Definitely that will impact the industry, but the serious players or the large players will come out well with it, because they more or less they are prepared. And then the industry will see a very, very natural growth with many of the unregulated or unauthorized players moving out from the ecosystem. So I think it's for the betterment of everyone that regulators or regulations start coming in. Might impact in a shorter period, but on the longer run, it will be very beneficial.
Absolutely. I think very, very well said. I think your point on, SRO, I think it has worked, as you rightly mentioned, very well for the microfinance industry. And you expect something like that to also, happen for the fintech space, fintech lending space?
Yes, definitely. If you look at the draft paper from the regulators, they have clearly put an emphasis that there should be an SRO kind of a body, so that it benefits the complete industry. In fact, we as a
yes,
member,
you have an entity, I think, called
exactly, where the idea of creating this entity is that overall interest of the customer is protected, and they don't get into a debt trap by taking loans from unauthorized, unregulated players. And we have also applied for the SRO status to the regulators, so that overall industry can benefit. And we have around 25 to 30 members as of now who have the digital lending presence along with the NBFC as a backing. So that's one of the criteria. And that is very important. Once you have a regulated entity in the group, you tend to follow the rules and work in a much more judicial manner as compared to just running a fintech platform, because then there is nobody to watch you on.
Absolutely. I think Rakesh also, I think he's also part of an association, Rakesh. Digital lending is what I had read about.
So basically, we have our own internal groups wherein we form our own credit policies.
Okay.
Particularly the credit policies that we form in the partnership and collaboration stuff that we talked about. I talked about earlier in terms of how do we do a partnership with a fintech partner. So
Right.
I'm part of that credit policy committee. But essentially, the endeavor out here is to to be able to understand, interpret the regulation, which we believe RBI is not only proactive. I guess Alok did talk about the proactiveness about the regulation part. Also, I like to add to it is that the policy framework today is not only proactive, it is also very enabling in nature. A lot of the policies are are a forethought, the way industry is alluding towards, the way RBI is able to see as to what the future for digital lending is going to look like. And in terms of evolving paradigm on the regulatory side, as far as your end borrower interests are concerned, in terms of the right way of addressing the grievances and right way of addressing the requirements, I guess the policy is enabling that. So as a part of few of the policy forward-looking policies of the private bank like Axis, I can tell you that we're working with the regulator in a very close in a very close ties, wherein we are very actively thinking as to what could be various parameters which needs to be taken care of, various various paradigms which needs to be factored in terms of designing the right way of the of the regulation environment. See, these are very important because this industry, in our view, also looks like growing leaps and bounds. There's a huge scope of this underserved and people in the nooks and corners. Their lending requirements have always been there. It's just that now they are getting access to the bank's finance and all that. And thanks to the fintech player who are giving that access to them. And banks are not required to do a lot of investment to be able to reach out to that community. So it's very important that a right enabling a regulatory environment is fostered, and which is such that it can scale itself to the growing and evolving needs of the industry. Right. That is what RBI is trying to put in place, and I guess banks and private banks and fintech partners are alluding towards it. Yeah.
Right. One specific question, Rakesh, in this regard. I mean, I think the panelists, all of us, we are talking about co-lending. And a lot of NBFCs whom we rate, including fintech, this co-lending has assumed a lot of interest. How, as a banker, do you think co-lending is really scalable in the long run? I mean, is this something that you believe will emerge as a very good growth platform?
Yeah, this is early days, Suman, and very relevant point. We personally think that, my personal view, I may not be necessarily access my view on this. Yeah. I think there's a huge scope in the co-lending structure. The way the co-lending structure today modeled by a large bank like ours and very close quarters with few of the very evolved and very forethought fintech partners is in a manner which is addressing the risk-taking abilities of the banks. See, banks have will piggyback on the on the very transactional enriched data which few of the fintechs would be running on the consumer behavior, on the transactional experiences that they bring on the table, because few of those fintechs are working very closely and they've seen the transaction pattern of those consumers, which a traditional banks may not have an access to. So in terms of even the risk policy formulation, a lot of forethought and convergence of thoughts between the fintech partner and banks comes together. The other part and very important part for the bank side is ability to take losses and NPAs and stuff. Now, this is where your co-lending and FLDG kind of a model becomes very, very important. I guess RBI has led a very good policies around that. They are discouraging corporates to do a FLDG kind of a model. The draft papers seem to suggest that it should be only with the evolve lending or NBFC kind of an entity which should be doing it. And I guess that is where the risk policy, risk formulations, having a right credit framework, policy decision making, and this policy decision making is then seen through the scans, through the matured eyes of private banks like ours. That makes it even more robust. And with the very right co-lending kind of a model happening, I guess the depositor's interest from a bank side can be really protected in a very ensuing manner, which is what is happening with this kind of a partnership model. So I really am a firm believer that co-lending model is while evolving and early stages,
Okay.
it is headed in a right trajectory and right direction.
Okay. Okay. Great. I will move to Pranay. Pranay, we talked about funding. We saw the kind of funding that has come in the fintech space, the lending space in fintech. You see new classes of investors in this space, whether from domestic or overseas. And specifically, is there interest of foreign investors in this space? And the third point is, do you see the debt investors also in this space, apart from those who are attracted to equity?
Sure. Suman, yes, I think there is definitely a renewed interest in the space, both from domestic as well as global investors. But if I were to just take a step back, right? If you look at the tech investors in general, and even the ones investing in fintech, right?
Right.
The preference historically, whether it's globally or in India, has always been to go after the asset-light models. They want the high-growth models, not the asset-heavy models, right?
True.
But I think all of them over time have come to realize, whether it's the ground realities or regulations, but they've all come to realize that India operates very, very differently. I think first is just the regulations, right? That you cannot just be a tech company and distribute products, use loopholes, use someone else's balance sheet, as Vivek was kind of pointing out.
Right.
The second aspect also is India traditionally has lacked the right products to kind of ensure wider financial inclusion, right? Whether it's on the personal lending side of the short tenure small ticket loans, or on the SME side, where you want the on tap loans that the SMEs might need. These products have not existed. With the fintechs are actually created, and to do this they need the the NBFC license and their own balance sheets. So a lot of foreign investors have now come to realize that this is how the models will work in India. I think second, as Alok and Vivek both pointed out, fintechs have also demonstrated that these products can now be actually delivered at a significant low cost, which the traditional models were lacking, and hence can still deliver the higher ROE profiles that the technology businesses typically are expected to deliver. And as again Rakesh was pointing out, the regulations around co-lending, etc., are further helping this cause. It allows some of the the relatively nascent NBFCs or the new NBFCs access to lower cost of capital, right? As well as technically the ability to take their gearing higher, right? Both of which allows these businesses to grow much faster. I think just in the last couple of years, we've seen the likes of a Google, SoftBank, Tiger Global, Insight Partners, which are pure technology investors otherwise, have actually invested behind balance sheet businesses in the country. Just one more point, right? These tech investors have also always typically invested in business models which are winner take all. Now, if you look at even the Indian market, right, they're also slowly realizing that in financial services, the businesses will never be winner take all, right? Everything will have to coexist. We've had 30 banks, we've had some 100 NBFCs, and likewise in fintech, it will not be a winner take all, but everyone will kind of tap into their niche and kind of grow and then become larger platforms. So we are seeing a lot of foreign interest. I think there's also interest from traditional private equity folks. As I pointed out previously, the fintechs have now grown in size. They've also kind of profitability is not as much of a concern, right? So even the traditional private equity folks who were otherwise investing in only very traditional lending models are now taking a lot of interest in fintech businesses. I think there's a lot more lot more class of investors that are actually looking at fintech.
Right, right. That's very encouraging to hear, Pranay. So now we will proceed for the last round of the panel discussion. The idea is we will just look into some specific operational challenges, profitability, etc., that we discussed in the presentation. So I'll start again with Alok. We picked up, as Mohit showed, and Sumit, We picked up around 25 companies and we did an aggregated analysis. We looked at those who are focused on small business loans. And this shows that, the ones that focus on small business loans, they are facing, obviously there's a constraint given the sample we have, but it seems that they have greater challenges on the profitability aspect. Do you expect that this issue of profitability to be sorted out in the near term, or this is something that's likely to remain for some more time? And on specifically because this is related to loan delinquencies, which I think our data is also showing that relatively, compared to small consumer loans, the delinquencies seem to be a bit higher. So is it related to the economic environment that we have? How do you look at this?
Yeah, Suman, I think there was a larger impact of the pandemic on small businesses. And to that extent, there was an escalation in risk. Different companies have taken different approach towards how quickly they want to recognize that pain and incorporate that into their financials. But we are seeing the gross NPA numbers fall rapidly over the last 2 or 3 quarters, as some of those delinquencies are accounted for. Inherently, I think the broader ecosystem needs to be educated better about why these losses and where are the investments happening from. Now, if you look at a conventional lending business, you should be profitable from day one, right? You're lending money, you're earning interest on it. It's a variable cost business. However, as you start to invest in digital lending, right, you're putting in investments that give you operating leverage down the line. We all spoke about the more efficient operating cost structure, but that comes at the expense of upfront investments, right? And hence, you are looking at businesses that will take longer to break even, but will deliver, higher operating leverage and higher return on assets at scale. Now, that is a fundamental difference in the business models of standard NBFC business vis-a-vis digital lending businesses.
There's an upfront technological investment.
Technology as well as credit models, right? Credit models need data to be built on, which means that there is to be a certain time period over which you write loans for that data to accrue.
Right.
So the timeline to building robust credit models is not something that can be circuited by making more loans in a given year, because you want time diversification to those loans.
Right.
Now, these are some of the fundamental drivers of the business model that need to be understood better. The difference between a consumer loan and MSME loans will vary a lot depending on what model specific companies are adopting. And also, what are the write-off policies that are being used? On a 3-month loan, people are not going to carry their delinquency for another 12-month period. And to that extent, you will see a faster rotation. So the metric that we look at is GNPA plus 12-month write-offs. On those, we have seen the MSME businesses operate fairly comparatively, both with the broader traditional MSME NBFCs. But also in comparison to consumer lending businesses.
Okay, so you're saying that it's quite comparable to the traditional NBFCs. Okay, great. So Vivek, some similar question to you also, that our study says that on an aggregate basis, consumer loan category have witnessed a kind of a turnaround in profitability in FY22. And we discussed, there are several reasons why, the ROI is better. So do you expect that the consumer, segment, it will continue to see healthy profitability from here on? Or, given the difficult environment, maybe we will see higher consumer delinquencies also?
So Suman, see, profitability is key for any of the businesses to survive in the longer run.
True.
And definitely, with the high interest rate, easy money flowing out of this system, profitability will be the key metrics, or I'll say one of the major metrics which will be looked by any of the investors into the company. Now, if you look at the overall fintech industry, where they have the advantage, right? They have the advantage over better servicing the customer at a lower cost, because digitally acquiring, digitally underwriting, and digitally servicing. Second advantage they have is pricing their product at a higher rate as compared to the banks. Now, if I look at what are the three concerns areas on the profitability for any of the fintech lending, one is the customer acquisition cost. Suman, what we have realized is over a period of time, for the same customer, everyone is fighting. It's not only the lending guys, it's the crypto guys, it's the card guys, or any other guys who are fighting for the same customer on Googles and Facebooks of this world. And these guys are increasing their cost of delivering the customer. Second is definitely the higher interest rate, right? Now, if you look at banks or other large NBFCs are still very cautious in giving or opening up the lending lines to the digital lending NBFCs and so on and so forth.
True.
Third pain point is high credit costs, right? The customers served by the digital lenders definitely are willing to pay more, but at the same time, the delinquencies or the credit costs will be higher for these customers. Because one of the key things which digital guys try to serve is they want to acquire they want to serve a good amount of new to credit customers. Now, what are the solutions for that? See, in terms of the CAC, definitely over a period of time, as and when digital lenders will be able to reduce their cost of funding and pass on the benefits, the stickiness of the repeat customers will be there, which in turn will give the lower delinquency. So these two things can be solved. Higher credit costs, definitely with a very high, updation of bureaus by the digital lenders these days. Somewhere people have become more and more cautious. And think of the customer base, which, for example, even we are serving, right? Our customer base, the median age is 27, 28-year-old. And the average ticket size, what we are giving is, say, 14,000 rupees. For a new customer, we are giving 3,000, 4,000 rupees. Now, for a 4,000 rupees, if the customer defaults, either they will remain credit hungry throughout their life, or at some point in the journey, they will come and pay back this loan because the ticket size is very low.
Correct.
So it's more of a discipline which needs to be bring in, the education which needs to be bring in, so that all these points can be taken care and the profitability can be achieved. See, end of the day, when we look at Credit Bee, Crazy Bee journey, we became profitable in 2 years of the inception, right? Because the idea was very clear that it's the very traditional business what we are doing, just the interface we are changing and we are building in the convenience. Otherwise, the model is saying you borrow at a certain rate, you lend at a certain rate, the NIMs you earn, and you have to make sure your cost is taken care and you generate the profit or a definite return. So profitability has to be very key component in this journey for the longer run. Otherwise, survival will be an issue.
Absolutely. I think very well said. At the end of the day, all investors and stakeholders, for them, profitability, return on capital is important, and all business models have to look into that aspect. I think you mentioned this point, but let me ask Rakesh also. I think the fintech space is yet to see in terms of borrowing that diversification which we see for conventional NBFCs. So we still see the absence of, let's say, for example, public sector banks or even some private sector banks. And the funding, debt funding, which this NBFCs, in our study that we saw, that mostly they are dependent on NBFCs, maybe HNIs, some funding. There are some banks, but not many. So how would a private sector bank, like, for example, Axis, or maybe you can talk generally, would look at taking exposure? If they have to take a debt exposure, what are the factors that one would look at?
So one of the very important pertinent point for the industry, for a long-term well-being of the entire financial ecosystem of the country, we all reckon the fact that underserved and unserved has to be given a line of credit. This can be in form of a consumer lending. It can be in form of a small business and MSME, which is where RBI and regulators are also focusing. So clearly, a large private sector bank like us has to take a step in their own interest. A, because this is a very profitable pie of business, and B, this falls stitched together in the entire financial inclusion narrative. So clearly, there has to be a lot which needs to be done out here. But the structures in which you will participate, in which this entire thing has to be evolved and stitched together, is where, where the devil lies in the details, So I think the ability of the banks to write a direct check on balance sheet lending, if that is what we are trying to allude to, to a fintech partners today, will be limited. It is going to take its own course. It is, we need to have a little more, data to back as to how this, this fintech players are evolving, because some of them will do a good business. I guess Alok and Vivek both made these points, that, some of them will evolve, as the regulatory paradigm is evolving, with the very robust business models, the way their deeper understanding with the data support which they are having, the kind of a consumer on lending and the borrowers on lending journey they are going to stitch together. The ones which have a robust business model will be here to stay, and this will be the right partners from the banking perspective. Pranay made a very relevant point. There's no dearth of capital as far as investor appetite is concerned. Even in this kind of a markets, you can see a very large ticket deals for Yes Bank is happening. So clearly, even for the fintech partners, Axis was one of the bank Access Capital, to be precise, for flexi loans, wherein a private round happened. And I'm sure Pranay does these deals day in, day out. So clearly, the fintech players who are able to demonstrate a very strong, robust business model, they will have keep on getting access to the financing, be it equity investor money or the even the lenders money. But I guess co-lending model today looks like a flavor of the season. That is where banks will be in a better position with a combination of corporate lending and some kind of a comfort on FLDG form, will be able to underwrite larger checks wherein the end borrower, MSME partner, or the consumer can be underwritten jointly with the fintech partner. But a direct standalone exposure on the fintech partner will take some time to evolve. That will be backed by how they are able to do continuously onboard the customer in a profitable manner, how they're able to ensure that collection is happening. The risk models are sort of are kind of adaptable in the nature and evolving with the collection efficiencies and all of this together. And they're able to write onto their risk models in a very adaptable manner. If all of this are happening, I guess they will get more and more financing. Banks will open up to this space. Banks are looking and they are clearly hungry for reaching to the last mile, nook and corner of the country as far as the reach out strategy is concerned. And this partnership will only evolve. But co-lending is more immediate in nature, and direct lending will happen in the course of time.
Right. Good point. I think this point that you mentioned about, and I think other panelists also mentioned about the differentiation about those players who are able to kind of achieve that profitability quickly or within a defined time frame, and those which are able to bring down cost, which are able to streamline their partnerships with banks, for example, they are likely to continue to get the support from the stakeholders, whether it is equity investors or whether they're debt holders. Given that there can be a differentiation in this whole sector, and some people will do well, some players may not do well. So my next question is to Pranay, and the last question in this round is: do you see any scope for consolidation, therefore, in this fintech lending segment, maybe M&As over the next few years? Given that there are a lot of them, there are quite a few small. Is there a kind of a rationale for M&A or consolidation?
Sure. So, I believe pure play lenders themselves might not merge, right? I don't think anyone gets anything out of acquiring a book per se. Right? Add to it just the regulatory hoops of because you're merging to NBFCs, getting RBI approvals, especially in the uncertain environment that we are in, and in the business of lending, when you always have credit cycles going on, right? Having said that, if there are opportunities for two players to come together with either complementary skill sets, let's say one has a very solid acquisition engine and one has a very solid underwriting and a collections engine, right? I think those complementary skill sets can maybe still make a case, and or two very different target audiences, right? Someone who's focusing only on, let's say, the 700 plus score audiences, and someone who's just focused on, let's say, the 600 to 700. I think again it makes sense. And lastly, I think there are a lot of players in the market, as I mentioned, during my in the first response, the top of the funnel players, right, who actually raised a lot of capital over the course of last year.
True.
And they will have a lot of pressure in the current environment, but also just over the next few years, right, to demonstrate monetization. And I think lending is where they will have to look towards, and that will probably force them to kind of look at joining hands with some of the lenders. So I think those plays we might see, as I said, just complementary skill sets and abilities, but otherwise pure play lenders coming together in the fintech space, very difficult. We've not seen that happening typically in the traditional space.
Right.
As
Right. Maybe too early to comment on that. And as you said, I think that there is still a space for evolution. If you look at the leverage levels also low. So I think maybe there is more funding from the debt side that is likely to come. So there is more action and growth that we expect before consolidation. So I think we have come to the conclusion. It is good if we can kind of conclude. I would just say, I think just to summarize the discussions, the presentation that we had, the discussions we had, and also what Subhendu sir mentioned, I think the whole fintech space, the way it's very encouraging the way it has evolved. But what is important is to get the right, a healthy ecosystem around it. So you have the right kind of engagements with your partners, which are banks. So you need to have stable funding. You need to have the right technology platform, and with the same principles that Subhendu sir mentioned, that the principle of transparency, consumer protection, governance. Which will all ensure systemic stability. I think the overall objective is not different for all stakeholders. It is the same objective of growth, benefiting the customer, and systemic stability. So if we are able to kind of coordinate among ourselves and kind of achieve these objectives, I think this sector will see a very healthy growth going forward. I think that's all we are all having the same objective that way. So thank you so much. And maybe Vineet, you can propose a vote of thanks, please, and we can conclude the session. Thank you all.
Thank you, Suman. Concluding further, let me take this opportunity to thank Shri Subhendu Pati, Mr. Alok Mittal, Mr. Vivek Veda, Mr. Rakesh Bhojnagarwala, Mr. Pranay Jai, and Mr. Suman Chaudhary for participating in this exciting webinar. I thank all our attendees and hope that you gained some valuable insights from this webinar. The full recording of this webinar will be available on our YouTube channel, Acuité Group, for you to share with your colleagues and industry network. We also plan to release a report on the fintech lending sector in a few days. If you wish to know more about Acuité Ratings and Research, please visit our website, www.acuité.in. We also publish regular research and opinion reports on various macroeconomic indicators, which includes our monthly commentary, Acuité Macro Pulse. Our next webinar in the Acuité NBFC Insights 2022 series will be hosted in October 2022. Follow us on our LinkedIn handle for more updates. Thank you for being with us. Wishing everyone a great evening ahead and good night.